When the lights go out and the sirens blare, who gets rescued first? When the ship is sinking and there are not enough lifeboats, who gets priority? In the world of finance, the answer is always the same. It is never you. Every economic crisis tells the same story. Banks make reckless bets, inflate bubbles, and chase profits until the entire system teeters on collapse. Then, when the inevitable crash comes, governments rush in with taxpayer money to save the very institutions that caused the disaster. Meanwhile, ordinary people lose their homes, their jobs, and their life savings. This is not an accident. This is the design. Bailouts are sold to you as economic necessity, as the only way to prevent total collapse. You are told that these banks are too big to fail, that saving them is really about saving you. But that is a lie wrapped in economic jargon and delivered by people who profit from your confusion. The truth is simpler and more brutal. Bailouts exist to protect wealth, power, and the system that concentrates both in the hands of the few. If you think this sounds cynical, wait until you see the evidence. From the savings and loan crisis of the 1980s to the subprime mortgage meltdown of 2008, from the pandemic bailouts of 2020 to the regional bank failures of 2023, the pattern never changes. Institutions gamble with other people's money, lose spectacularly, and then get rescued while their victims are left to fend for themselves. This is not just about economics. This is about power. And understanding how bailouts really work is the key to understanding why the financial system feels rigged against you, because it is rigged against you. Let me paint you a picture of how this works. Imagine you run a casino, but with one special twist. Every time you lose a bet, the government steps in and covers your losses with money taken from the very people you just finished fleecing. Every time you win, you keep the profits. Every time you lose, someone else pays the bill. Would you take risks in that casino? Of course you would. You would take enormous, reckless risks because you could never actually lose. That casino is the modern banking system. And you are not the house. You are not even the player. You are the one paying for the chips. Here is how it starts. Banks, investment firms, and financial institutions discover new ways to make money. Sometimes it is mortgage-backed securities. Sometimes it is derivatives. Sometimes it is cryptocurrency or foreign exchange speculation. The details do not matter because the pattern is always identical. These institutions leverage themselves to the moon, borrowing massive amounts to amplify their bets. When times are good, the profits flow upward. Bank executives receive bonuses worth millions. Shareholders see their investments soar. Politicians get campaign contributions and speaking fees. Everyone in the club gets rich while ordinary people are sold the illusion that rising asset prices mean prosperity for all. But leverage is a double-edged sword. The same mechanism that amplifies profits when things go right amplifies losses when things go wrong. And things always go wrong eventually because the system is built on borrowed time and borrowed money. When the crash comes, it comes fast. Lehman Brothers collapsed in a matter of days. Silicon Valley Bank went from healthy to insolvent in less than 24 hours. The speed is not accidental. It is the inevitable result of a system where everyone is connected, everyone is leveraged, and everyone assumes someone else will catch them when they fall. And this is where the bailout machine kicks into gear. Suddenly, the same institutions that spent years telling you about free markets and personal responsibility start screaming about systemic risk and economic contagion. The banks that profited from taking enormous risks now claim they are too important to fail. The executives who pocketed millions in bonuses now warn that letting their institutions collapse would hurt everyone. They are not entirely wrong about the consequences. When large financial institutions fail, the damage does ripple through the economy. Credit freezes, businesses cannot get loans, unemployment rises, and ordinary people suffer. But here is what they will never tell you. That interconnectedness, that systemic risk, was created deliberately. It is not a bug in the system. It is a feature. By making themselves indispensable to the broader economy, these institutions have essentially taken the entire financial system hostage. They can gamble as recklessly as they want because they know the government cannot let them fail without triggering a broader collapse. It is the perfect crime. Privatize the profits, socialize the losses, and hold the whole economy as collateral. The politicians and regulators play their part perfectly. They hold emergency meetings, draft urgent legislation, and explain to the public why billions of taxpayer dollars must be rushed to failing banks. They use phrases like liquidity crisis, systemic risk, and moral hazard. But the message is always the same. We have to save them to save you. But what they never mention is the alternative. What if instead of bailing out the banks, governments bailed out the people? What if instead of rushing trillions to Wall Street, they sent that money directly to homeowners facing foreclosure, to small businesses struggling to survive, to workers who lost their jobs because of decisions made in boardrooms they will never see? This is not a hypothetical question. Other countries have tried different approaches. When Iceland's banking system collapsed in 2008, the government let the banks fail and focused on protecting ordinary citizens instead. They prosecuted bank executives, restructured debt for homeowners, and rebuilt their financial system from the ground up. Within a few years, Iceland had recovered while countries that bailed out their banks were still struggling with debt and austerity. But that approach requires something the establishment cannot tolerate. It requires admitting that these institutions are not essential, that their failure would not end civilization, and that protecting ordinary people matters more than protecting bank shareholders. It requires breaking the cycle of privatized profits and socialized losses that has made banking the most profitable business model in human history. Instead, we get the same script every time. The crisis emerges, panic spreads, and suddenly the people who created the mess become the indispensable experts needed to fix it. Former Goldman Sachs executives become Treasury secretaries. Bank lobbyists write the bailout legislation. The very people who should be in prison become the architects of the rescue plan. And the rescue always follows the same formula. Inject capital into failing institutions to keep them afloat. Guarantee their debts so creditors do not panic. Lower interest rates to make borrowing cheaper. Print money to flood the system with liquidity. All of it funded by taxpayers who had no voice in the decisions that created the crisis. The numbers are staggering. During the 2008 financial crisis, the Federal Reserve committed over $16 trillion to various bailout programs. That is more than the entire gross domestic product of the United States at the time. During the pandemic, another $4 trillion was created and distributed, much of it flowing to corporations and financial institutions, while ordinary Americans receive one-time payments of $1,200. But the real cost is not measured in dollars. It is measured in the moral hazard created when failure has no consequences. When banks know they will be rescued, they have every incentive to take bigger risks, to leverage themselves higher, to chase returns that would be insane for any institution that actually faced the possibility of bankruptcy. This creates what economists call a doom loop. Bailouts encourage reckless behavior, which leads to bigger crises, which require bigger bailouts, which encourage even more reckless behavior. Each cycle makes the system more fragile and the inevitable crash more devastating. We are not solving the problem. We are making it worse. The human cost is hidden in statistics and spread over years, but it is real. Every bailout is funded by inflation, by debt, by the slow erosion of purchasing power that eats away at wages and savings. Every rescue of a too-big-to-fail institution makes those institutions bigger and more powerful, while making everyone else smaller and more vulnerable. So here is the truth they hope you never understand. Bailouts are not about saving the economy. They're about preserving a system that enriches the few at the expense of the many. Every crisis is an opportunity to transfer more wealth upward, to make the powerful more powerful, and to ensure that when the next disaster strikes, the same people will be there to profit from the chaos. The cycle will continue until enough people recognize it for what it is, a theft so vast and so brazen that it hides in plain sight.